Picture this, a vast, intricate network of financial transactions happening outside the familiar world of banks. Imagine a world where money flows like water, but not through the usual channels. This is a realm where traditional banking rules don't always apply and the stakes are incredibly high. It's a place where money moves fast, risks are high, and the rules are, well, a bit blurry. Here, fortunes can be made or lost in the blink of an eye. The pace is relentless and the atmosphere is charged with tension and excitement. This is the hidden world of shadow banking. It's a world that operates in the shadows, away from the prying eyes of regulators and the general public. Transactions are often opaque, and the players involved prefer to remain anonymous. You might not see it, but it's there, lurking beneath the surface of the financial system. It's like an iceberg with only a small part visible above the water while the bulk remains hidden below. This hidden part can have a massive impact on the financial landscape, and like it or not, it plays a crucial role in the global economy. Shadow banking provides liquidity and credit to markets that might otherwise be underserved. It can drive innovation and growth, but it also comes with significant risks. We're talking trillions of dollars flowing through a system that most people don't even understand. These transactions can be complex and involve a web of financial instruments and entities. The sheer scale of it is mind-boggling, but understanding it is more important than ever. As the global economy becomes more interconnected, the impact of shadow banking can be felt far and wide. It's essential to grasp how this system works to navigate the financial world effectively. Why? Because what happens in the shadows doesn't always stay there. The ripple effects can spread throughout the entire financial system, affecting everything from interest rates to the availability of credit. The 2008 financial crisis proved that. Remember that whole mess? It was a stark reminder of how interconnected and fragile the financial system can be. Shadow banking was a significant factor in the crisis, highlighting the need for greater transparency and oversight. Yeah, shadow banking played a starring role. So, buckle up. We're about to delve into the intricacies of this shadowy world, exploring its origins, its impact, and what the future might hold. We're about to shine a light on this shadowy world, and trust us, it's going to be an interesting ride. Stay with us as we uncover the secrets of shadow banking and reveal how it shapes the financial landscape in ways you might never have imagined. All right, let's cut to the chase. What exactly is shadow banking? It's a term that might sound a bit mysterious or even ominous, but it's a crucial part of our financial system. In a nutshell, it's a bunch of financial institutions that act like banks, but aren't technically banks. These entities include hedge funds, private equity funds, and other non-bank financial intermediaries. They lend money, they invest money, they do all sorts of bank-like things. They provide credit and liquidity to the financial system, often operating in the shadows of traditional banking. But here's the catch. They don't have the same safety net as traditional banks. This means they aren't subject to the same rigorous regulations and oversight. Think of it this way. Traditional banks are like your grandma's house, safe, regulated, and maybe a bit boring. They follow strict rules to ensure your money is protected. Shadow banking, on the other hand, is more like a Las Vegas casino, exciting, risky, and with way fewer rules. The potential for high rewards is there, but so is the potential for significant losses. So, why does shadow banking even exist? The answer lies in the flexibility and opportunities it offers. Well, sometimes it's easier to borrow or invest money outside the traditional banking system. Traditional banks have stringent lending criteria and regulatory requirements that can slow down the process. Maybe you're a big company that needs a quick loan, or maybe you're looking for a high-return investment. Shadow banking can provide faster access to capital and potentially higher returns. Shadow banking can offer those options. It can be a lifeline for businesses and investors looking for alternative financial solutions. But remember, with great power comes great responsibility. The lack of regulation means that the risks are higher and the consequences of failure can be severe. And in the world of shadow banking, that responsibility isn't always clear. The lack of transparency and oversight can lead to financial instability and crises. We've seen this play out in the past, most notably during the 2008 financial crisis. Shadow banking played a significant role in the build-up of risk that led to the collapse. Since then, there have been efforts to bring more transparency and regulation to the shadow banking sector. However, it's a complex and ongoing challenge. As the financial landscape continues to evolve, shadow banking will likely remain a key player. It's a dynamic and innovative part of the financial system, constantly adapting to new opportunities and challenges. For investors and businesses, understanding shadow banking is crucial. It offers opportunities, but also requires careful consideration and informed decision-making. So the next time you hear about shadow banking, remember that it's not just a shadowy corner of the financial world. It's a vital, albeit risky, component that requires respect and understanding. By staying informed and making responsible choices, we can navigate the complexities of shadow banking and contribute to a more stable financial future for everyone. So who are these mysterious players in the shadow banking world? It's a motley crew, to say the least. We've got hedge funds, private equity firms, money market funds, and a whole bunch of other financial institutions with fancy names. Think of them as the characters in a financial thriller, each with their own motives, strategies, and appetite for risk. There's the high-rolling hedge fund manager, always on the lookout for the next big bet. Then there's the private equity firm buying up companies and shaking things up. And let's not forget the money market fund promising higher returns with a side of potential instability. It's like a financial ecosystem with each player interconnected and influencing the others. And when one part of the system starts to wobble, the whole thing can feel the tremors. Now let's talk about how this whole shadow banking thing actually works. Shadow banking is a term that might sound a bit mysterious or even ominous, but it's really just a part of the financial system that operates outside the traditional banking sector. It involves a variety of financial activities and institutions that provide services similar to traditional banks, but without the same regulatory oversight. It's all about moving money around from people who have it to people who need it. Sounds simple, right? But there's a lot more to it than just transferring funds. Shadow banks play a crucial role in the financial ecosystem by providing liquidity and credit to various sectors of the economy. They help facilitate investments, manage risks, and support economic growth. Well, it can get pretty complicated. The operations of shadow banks involve intricate financial instruments and strategies that can be difficult to understand. They use tools like securitization, repurchase agreements, and derivatives to manage their activities and generate profits. These instruments can be highly complex and require sophisticated risk management techniques. One key mechanism is something called maturity transformation. This is a process where shadow banks borrow funds on a short-term basis and lend them out on a long-term basis. It's a way to bridge the gap between the short-term needs of investors and the long-term needs of borrowers. Imagine borrowing short-term and lending long-term. This can create a mismatch in the timing of cash flows, which can be risky if not managed properly. However, it also allows shadow banks to provide long-term financing to businesses and individuals who need it. That's what shadow banks often do. They take short-term investments from individuals and institutions and use those funds to make long-term loans. This process helps to channel savings into productive investments, supporting economic development and growth. They take your short-term investments and use them to make long-term loans. This can include loans for businesses to expand, mortgages for home buyers, and other types of credit that support economic activity. Another important aspect is credit intermediation. This is the process of connecting borrowers and lenders, facilitating the flow of credit in the economy. Shadow banks act as intermediaries, helping to match those who need funds with those who have funds to invest. That's just a fancy way of saying they connect borrowers and lenders. By doing so, they help to ensure that capital is allocated efficiently, supporting economic growth and development. But unlike traditional banks, shadow banks don't have the same strict lending standards. This can make it easier for borrowers to obtain credit, but it also means that shadow banks may take on higher levels of risk. They're willing to take on more risk, which can be both a good and a bad thing. On the positive side, it can provide access to credit for borrowers who might not qualify for traditional bank loans. On the negative side, it can lead to the accumulation of risky assets that may pose a threat to financial stability. On the one hand, It can make it easier for businesses to get funding. This can be particularly important for small and medium-sized enterprises that may have difficulty accessing traditional bank loans. By providing these businesses with the capital they need, shadow banks can help to drive innovation and economic growth. On the other hand, it can lead to a build-up of risky loans, which, as we've seen, can have some pretty nasty consequences. During times of financial stress, the risks taken on by shadow banks can become apparent, leading to potential losses and instability in the financial system. This is why it's important to understand how shadow banking works and the potential risks involved. Stay tuned as we uncover more hidden aspects of this financial phenomenon. Shadow banking doesn't just operate in isolation, its tentacles reach into every corner of the global economy. By providing essential credit and liquidity, shadow banks play a significant role in economic growth and development. However, this influence comes with a price. One of the major impacts of shadow banking is its ability to enhance financial inclusion. By offering credit to individuals and businesses that traditional banks might overlook, shadow banks help to drive entrepreneurship and innovation. Small and medium-sized enterprises in particular benefit from the accessibility of funds, allowing them to invest, grow, and create jobs. But this increased accessibility can also lead to systemic risks. The lack of stringent regulatory oversight means that shadow banks can accumulate significant amounts of risky assets. These assets, if not managed properly, can become a ticking time bomb for the financial system. During times of economic stress, the risks associated with shadow banking become more apparent. The 2008 financial crisis is a prime example of how the interconnectedness of shadow banks with the traditional financial system can lead to widespread instability. The crisis highlighted the vulnerabilities of shadow banking, where the failure of one entity can trigger a domino effect, impacting the entire global economy. Another critical risk is the potential for regulatory arbitrage. Shadow banks often exploit regulatory loopholes to engage in activities that would be restricted or heavily regulated within the traditional banking sector. This can create an uneven playing field and lead to unfair competition, as well as increased risk-taking behaviors. So, while shadow banking provides essential services and supports economic growth, it also introduces significant risks that need careful management. Regulatory bodies worldwide are continually working to strike a balance between fostering innovation and ensuring financial stability. The challenge lies in crafting regulations that are flexible enough to adapt to the evolving financial landscape without stifling the benefits that shadow banks bring to the table. As we continue to navigate the complexities of the financial world, understanding the role and risks of shadow banking becomes increasingly important. By shedding light on these hidden aspects, we can better prepare for potential challenges and work towards a more resilient global economy. Stay tuned for our next chapter, where we will explore real-world examples and case studies that illustrate the profound impact of shadow banking on our daily lives. Now let's take a closer look at some real-world examples of shadow banking in action. We'll examine case studies and analyze how these entities operate behind the scenes. One of the most prominent examples is the role of mortgage-backed securities (MBS) in the 2008 financial crisis. Shadow banks, such as investment banks and mortgage companies, played a pivotal role in creating and selling these complex financial products. These securities were backed by subprime mortgages, loans given to borrowers with poor credit histories. As housing prices began to fall, the value of these securities plummeted, leading to massive losses for financial institutions worldwide. This case study highlights how shadow banking activities can have far-reaching consequences when not properly regulated. Another notable example is the rise of peer-to-peer (P2P) lending platforms. These platforms connect individual borrowers with lenders, bypassing traditional banks. While P2P lending has democratized access to credit, it has also raised concerns about default rates and the lack of investor protection. In 2018, China experienced a wave of P2P platform collapses, leaving millions of investors facing significant financial losses. This incident underscores the need for robust regulatory frameworks to ensure the stability and integrity of shadow banking operations. Let's also consider the case of money market funds, which are a cornerstone of the shadow banking system. These funds offer short-term, low-risk investment opportunities and are often used by corporations to manage liquidity. However, during the 2008 crisis, the Reserve Primary Fund broke the buck, meaning its net asset value fell below $1 per share. This event triggered a panic among investors, leading to a run on money market funds and necessitating government intervention to restore stability. These case studies illustrate the dual nature of shadow banking. While it can drive innovation and provide essential financial services, it also carries inherent risks that can destabilize the global financial system. By examining these real-world examples, we gain a deeper understanding of the complexities and challenges associated with shadow banking. This knowledge is crucial for developing strategies to mitigate risks and enhance the resilience of our financial systems. As we continue to explore the shadowy corners of the financial world, it becomes clear that vigilance, transparency, and regulation are key to harnessing the benefits of shadow banking, while safeguarding against its potential pitfalls. What are the global efforts to mitigate the risks associated with shadow banking? The first challenge lies in the very nature of shadow banking. These entities operate outside the traditional regulatory framework, making it difficult for authorities to monitor and control their activities effectively. Pause 3S. However, various international bodies have recognized the need for enhanced oversight. The Financial Stability Board, FSB, for instance, has been at the forefront of efforts to address the risks posed by shadow banking. Pause 2S. The FSB has developed a framework to monitor and evaluate the shadow banking system, identifying vulnerabilities and proposing policy recommendations to mitigate risks. Similarly, the Basel Committee on Banking Supervision has introduced measures to strengthen the resilience of the banking sector, including guidelines to limit banks' exposures to shadow banking entities. These efforts aim to reduce the interconnectedness between traditional banks and shadow banks, minimizing the risk of contagion in times of financial stress. At the national level, countries like the United States, European Union, and China have implemented specific regulations to oversee shadow banking activities. In the US, the Dodd-Frank Act introduced significant reforms to enhance transparency and accountability in the financial system, including provisions to regulate shadow banking entities. The European Union has also taken steps to address the risks associated with shadow banking through initiatives like the EU's Shadow Banking Roadmap, which outlines a comprehensive approach to monitoring and regulating non-bank financial entities. In China, the government has implemented stricter regulations on P2P lending platforms and other shadow banking activities to protect investors and maintain financial stability. While these efforts represent significant progress, challenges remain. The shadow banking sector continues to evolve rapidly, and regulatory frameworks must keep pace with these changes to remain effective. Moreover, the global nature of shadow banking necessitates international cooperation and coordination. Regulatory arbitrage, where entities exploit differences in regulatory regimes across countries, remains a concern that requires a unified approach. In conclusion, addressing the regulatory challenges posed by shadow banking is a complex and ongoing process. By enhancing transparency, strengthening oversight, and fostering international collaboration, we can mitigate the risks associated with shadow banking and ensure the stability of the global financial system. As we navigate the intricate landscape of shadow banking, it is clear that vigilance, innovation, and cooperation are essential to safeguarding our financial future. Finally, we will summarize the key points discussed in this video and provide some insights into the future of shadow banking. What can we expect in the coming years, and how can we stay informed about this ever-evolving sector? Throughout this video, we've delved into the complex world of shadow banking, uncovering its mechanisms, players, and the significant risks it poses to the global financial system. We've explored how shadow banking operates outside traditional regulatory frameworks, making it a challenge for authorities to monitor and control. Yet, despite these challenges, international bodies like the Financial Stability Board and the Basel Committee on Banking Supervision are working tirelessly to enhance oversight and mitigate risks. On a national level, countries like the United States, European Union, and China have implemented specific regulations to oversee shadow banking activities. These efforts aim to reduce the interconnectedness between traditional banks and shadow banks, minimizing the risk of contagion during financial crises. Looking ahead, the shadow banking sector will continue to evolve, driven by technological advancements and innovative financial instruments. As new forms of shadow banking emerge, regulatory frameworks must adapt to keep pace with these changes. The global nature of shadow banking necessitates international cooperation and coordination to address regulatory arbitrage and ensure a unified approach to oversight. To stay informed about the future of shadow banking, it is crucial to keep an eye on developments in financial technology, regulatory changes, and the activities of key players in the sector. By staying vigilant and informed, we can better understand the risks and opportunities presented by shadow banking and navigate the financial landscape with greater confidence. In conclusion, the road ahead for shadow banking is fraught with challenges and opportunities. By enhancing transparency, strengthening oversight, and fostering international collaboration, we can mitigate the risks associated with shadow banking and ensure the stability of the global financial system. Thank you for joining us in this exploration of shadow banking and its regulatory challenges.